Global markets take the White House clash between Donald Trump and Volodymyr Zelensky in their stride. This week's tariff deadlines are more in focus, boosting the US dollar, in particular versus the Canadian dollar. Australian lending growth softens, and New Zealand consumer confidence remains subdued. That's coming up in our 5 Things in 5 Minutes on Monday, March the 3rd. And then, in today's bonus deep dive interview, ANZ economist Henry Russell analyses how New Zealand's housing market has started 2025.
Underlying momentum in the market is starting to shift, but the starting point is one of a very loose market, and so that will take time to overcome before we see a meaningful upswing in prices.
But first, in 5 and 5 with ANZ, the US dollar is strong again this morning across most currencies, thanks to ongoing inflation fears linked to Trump's tariffs and safe haven buying. The US dollar rose another 0.35% to a 1-month high on Saturday morning, despite another fall in the US Treasury yield of 8 basis points to 4.20% for the 10-year. That's a new closing low for the year. That's because the other side of the stagflationary fears is lower economic growth, dragging on inflation in the longer run. ANZ's head of FX research, Marja bin Zaman, says there are deadlines looming this week that will keep the upward pressure on the US dollar.
The tariff views are very much in play, and with the 4th of March are looking to play out for Canada and Mexico as of now. But even beyond that, we've got 12th of March where steel and aluminum tariffs are expected to go live. We don't know about any exemptions as yet. And then, of course, 1st and 2nd April are risk events for us. We've got 1st of April, we've got the trade review, and then on the 2nd of April, reciprocal tariffs if they are played out. So, these are risk events, and this kind of falls into the view that we continue to maintain to see a stronger dollar going forward.
As of 4 a.m. Sydney Melbourne time, the Aussie dollar was down 0.3% to 62.07 US cents. The Kiwi was down a touch at 55.97 US cents, near a 1-month low. The S&P 500 and Nasdaq closed up 1.6% on Friday, recovering from an initial dip on the news on Friday afternoon of Donald Trump's White House clash with Ukraine's President Volodymyr Zelensky. Number 2. Marja bin says the Canadian dollar is one to watch this week, ahead of Tuesday's March the 4th deadline for 25% tariffs on US imports of Canadian goods.
Recent comments from Trump suggest that these tariffs are likely to go ahead, and we've already seen dollar CAD shift higher on this news. We continue to expect Canadian to largely continue to be impacted, but it also depends to what extent the tariffs go into play. Will there be any exceptions? Of course, we know oil will be lesser impacted, oil exports, as opposed to other merchandise. So I think we really have to see the breakdown.
Number 3. Data from Japan's economy out on Friday showed Tokyo headline inflation a touch weaker than expected in February and industrial production down for the month, although retail sales improved 0.5%. Looking through the ups and the downs, ANZ FX analyst Felix Ryan says the underlying inflation story in Japan remains robust.
Looking at all the data in totality still are suggestive of quite a robust Japanese economy and also growing price pressures that will give the Bank of Japan some confidence to hike rates again in the near term this year. At the moment, we're still looking for the 1% terminal rate by the end of this year, so that's 2 more rate hikes by the Bank of Japan at this stage.
Number 4. In Australia, data out on Friday showed private sector credit growth in January from December of 0.5%. That was in line with expectation, but softer than the 0.6% seen in December from November, says ANZ Australia economist Maddie Dunk.
Our broad view on private sector credit is that you may see more of a slowdown coming through. If you think about what we're seeing with some of the business numbers, so for example, earlier last week we had the CapEx numbers come out. They were softer than expected, and particularly those intentions were softer than expected. And you might see signs of business caution flowing through to that business credit growth moving forward. And then I think the cooling in the housing market will also flow through into the credit data.
Number 5. In New Zealand on Friday, the ANZ Roy Morgan Consumer Confidence Survey results for February came out. They showed a marginal improvement from January. They remain at very subdued levels, says ANZ New Zealand Chief Economist Sharon Zollner.
But times are still tough for quite a lot of households. Inflation has come down a long way, but households don't entirely believe it. I think it's fair to say inflation expectations are still 4%, even though the actual last measure of inflation was around half of that. So as long as people still have the perception that the cost of living is going up relentlessly, I think that will probably feed into some caution on spending.
Sharon Zollner there. Now, in our bonus deep dive interview, ANZ economist Henry Russell talks about the green shoots showing through in New Zealand's housing market, although it will be a slow shift up in gears over the first half of 2025 as the rate cuts take effect.
So January's housing market snapshot left off where we were to end 2024. We saw a modest lift in house prices, but sales volumes ticked down a touch, although the upward trend that's been in place since September remains intact. While the lift in sales today at face value does suggest upwards pressure on house prices moving forward, that's only one side of the house price equation. And the other side, housing supply, is also responding. And in January saw a surge in new listings coming onto the market, and the overall level of stock currently sitting on the market is the highest in nearly a decade. As a result, we do expect that house price momentum will be fairly muted in the near term, but stepping back from that and looking forward to the year ahead, our expectation is that momentum will build and house prices will ultimately rise 6% over 2025.
So what signals are you looking for over the next few months to really be certain about that forecast?
What we'd need to see to provide further confirmation that house prices are lifting is further lifts in sales volumes. These have returned to around the long-run historic average for this time of year, but given that there is a lot of stock on the market, we do ultimately need to see sales volumes push higher to start putting some downward pressure on that stock overhang and tighten the market. There are some signs that that is underway. If you look at broader measures of housing market tightness, they have at least stabilised or on a tightening trajectory. The likes of the number of days properties are taking to sell, that was trending higher over 2024, but has since stabilised and now looks to be turning. And as such, that does indicate that the underlying momentum in the market is starting to shift, but the starting point is one of a very loose market, and so that will take time to overcome before we see a meaningful upswing in prices. Our expectation is that's a story for later in 2025 rather in the first half of this year.
So we're likely to see more rate cuts from the Reserve Bank in the first half of the year. Is it fair to say that that's showing through into the data at the moment, or is it only just about to start pushing momentum in the housing market?
We certainly have seen the impacts of lower interest rates to date. With a lift in housing market activity, credit growth has been fairly strong and broadly confidence is returning to the market. But those impacts will continue to flow over the months ahead. It does take some time to see the full impact, and part of the reason for that is that labour market conditions in New Zealand still remain very loose, and as a result that's weighing on households' confidence to borrow and purchase housing. We do expect that will continue to play out in the near term, but our forecast is for labour market conditions to stabilise in New Zealand in the first half of 2025 and then ultimately start to recover in line with the broader economy, which with recent data continuing to suggest that a recovery in the economy is already underway. In terms of where mortgage rates will head moving forward, we do think that the vast majority of the downward adjustment is behind us, and that simply reflects the fact that markets are forward-looking and the wholesale interest rates which underpin retail mortgage rate already largely reflect the easing that both we, the market, and of course the Reserve Bank expect to deliver over the coming months. And so on our forecast, we do expect most mortgage rates to fall to around 5% in the first half of this year. That will still leave mortgage rates higher than they were pre-COVID, but nonetheless the falls to date have been significant and contributing to a relative improvement in affordability with respect to lower debt servicing costs for households.
Henry Russell there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, March the 3rd. Catch you tomorrow with a preview of China's 14th National People's Congress in Beijing on Wednesday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.